What we mean by corporate restructuring, so sometimes the company, due to certain circumstances, it can actually basically change the form as to how it actually operates. So several factors can actually make a company to do what we call restructuring. So it's just the change of form of operations, or basically how the company carries out its business activities. So that's what we mean by corporate restructuring. It's simply where the company changes how it carries out its operations or carries out its business activities. So also what will happen, the company can do it by looking for internal means or actually going for external means. By internal means, we simply mean that, for example, the company could decide they're going to merge some of the departments so that they can actually maybe improve on their efficiency or maybe save on costs, or sometimes they could actually basically even split the departments. So they have several departments in the company. For example, in this case, if the company has, for example, a sales and marketing department, so you can actually be able to split it and actually have a sales department on its own and a marketing department on its own. For example, in this case, the company could be having, for example, a maybe bookkeeping department and, for example, an auditing department. So they decide to basically merge the auditing department and the bookkeeping department. Maybe they are doing this to basically to be able to do what we call utilize maybe the workforce or the talent they have in the company efficiently, because they have discovered these persons who are actually basically carrying out auditing work for the company, they can be able to do proper bookkeeping for the clients of the company. Or they could decide they're going to merge auditing and actually business advisory, because those who are carrying out auditing can actually efficiently be able to carry out or do the duties of business advisory. In that way, the company is actually able to utilize the talent or the workforce they have in the company very properly. So that is what we mean by restructuring. Those are basically examples of how the company can be able to restructure. When you talk about going for external means, the company can decide basically to merge with other companies to remain competitive in the industry it is actually operating in. What we mean by this, for example, in this case, we can give best examples in maybe 2 or more industries. If you look at, for example, the supermarket industry, so that particular industry, so there's this particular supermarket, now, that has actually taken over the market. It is known as Quick Mart. So there was actually basically a particular point whereby, I don't know, they merged or basically they acquired another supermarket known as Tumaini. So basically they could do that to remain competitive with the other giants in the industry, like, let's say, for example, by that time, Tuskys, so that they can actually take a bigger share of the market. If you look at the banking industry, we have, for example, this one, about it, NIC Bank actually being able to merge with Commercial Bank of Africa. So basically that one simply means that these particular 2 banks are actually merging, for example, to have huge assets or maybe to control a huge clientele base and remain competitive in that industry with other bigger players, like, let's say, for example, Equity Bank. So what should actually go at home is basically what we mean by corporate restructuring. The company is basically changing the way it carries out its business activities or it carries out its operations due to several circumstances, as we've mentioned, maybe to utilize the talent it has in the company properly, to cut on costs, or to remain competitive in a particular industry, or maybe to utilize the technology acquired efficiently. So you see, sometimes, for example, banks are actually able to do away with tellers because there is new technology that is actually supposed to be utilized in terms of, for example, taking deposits and actually being able to even do what we call withdrawal of money. So that is what we mean by restructuring in a nutshell. So there are several ways of how it can happen. We can have compromises. Yes? There's someone who has a question?
Yes, kindly pardon for me the reasons for corporate restructuring.
Reasons for corporate restructuring?
Yes.
Okay. So that is basically the importance. So as I've said, corporate restructuring is where the company changes the way it carries out its business activities or operations, either by going for external means or internal means. It is simply the way the company changes how it carries out its business activities through external means or internal means. Examples of internal means: merging departments, That is an internal means. External means we could talk about merging with other companies. The importance, we can talk about to cut on costs or save on costs, ensure that they are saving or basically cutting on costs. Number two, you can talk about utilize the talent they have properly, so utilize the talent they have efficiently. So utilize the talent they have efficiently. Utilize the talents they have efficiently. To remain competitive in the industry the company operates in, to remain competitive in the industry the company operates in, to remain competitive in the industry the company is operating in, to remain competitive in the industry the company is operating in. To remain competitive in the industry the company is operating in. The next one you can talk about to do away with products. To do away with products. To do away with products. To do away with products or accounts which are not performing. To do away with products or accounts which are not performing. To do away with products or accounts which are not performing. To incorporate, another one is to incorporate new technology in the company. 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 The next one is to decrease or consolidate debts. Madeni, debts, what do you mean by to consolidate or decrease debts, to consolidate or decrease debts, or decrease debts, to consolidate or decrease debts, to consolidate or decrease debts, to consolidate or decrease debt. So those are some of the reasons or the importance of corporate restructuring. So they could ask what are the importance or what are the reasons as to why a company can actually restructure. So those are the importance or some of the reasons as to why the company can actually be able to restructure or change the form of how it actually operates. So I was just trying to explain some of the types of ways of how the restructuring can actually happen. So before maybe you jot down something or write down something, maybe I can just explain to you, for example, these ones that I've just listed on the board. So we have, for example, what we call compromises and schemes of arrangements. We have, for example, mergers. We have, for example, acquisitions and takeovers. We have divestitures, share capital reduction, or, for example, joint ventures. So what we mean by compromises and schemes of arrangements, it is simply where the companies, for example, the companies, debenture holders or maybe creditors decide to change their interest in the company. So they simply enter into compromises with the company. For example, if the company is not actually able to meet the obligations, because as we said under debt capital, that the debenture holders of the company actually expect what we call interest from the company and the principal amount. So in this case, if the company is not actually able to pay those particular obligations in terms of the principal and interest, it simply means that these debenture holders could actually recommend the company be liquidated. So instead of having to go that particular route, these debenture holders can basically change or convert their interest in the company. Instead of them actually having to be debenture holders, they simply convert their interest in the company. They simply convert their interest in the company and they become shareholders. This one will simply lessen the burden, of the company, because in this case, if you are a shareholder, you'll simply expect dividends from the company. And as I told you previously in my previous classes, dividends will actually only be paid out of what we call distributable profits. So if the company is struggling, it simply means that it is not actually making profits, and therefore that dividends won't actually be paid. But for the interest, for the debenture holders or the creditors, it is mandatory to be paid as to whether the company has made profits or not. So if that one actually happens, where the company is actually struggling to be able to pay these particular amounts to creditors or debenture holders, they can simply convince the debenture holders to convert their interest in the company. And of course, instead of them being debenture holders, they actually become shareholders. If they do that, they simply say the company has been able to enter into what we call compromises with the debenture holders, and they have crafted a scheme of arrangement whereby they are going basically to become shareholders of the company. With that, basically, the company will actually be able to restructure, and it can actually be able to avoid actually being maybe liquidated by the debenture holders. So it is simply where the company enters into compromises and basically crafts a scheme of arrangement with, for example, the creditors of the company, and they convert their interest in the company and they become actually shareholders. That one actually simply lessens the burden of the company, because these shareholders, the expectation is only dividends, which is actually only supposed to be paid out of profits. If there are no profits, they simply come out empty-handed. For example, in this case, for the debenture holders, the interest is mandatory as to whether the company has made profits or not. So sometimes we normally say these particular ways of restructuring are actually what we call alternatives to actually having to be liquidated or actually being wound up. So sometimes they could ask, what are the alternatives to actually being liquidated? You can simply be able to mention this one, because with this one, the company can actually escape ending its life or actually being liquidated, or basically the creditors or debenture holders recommending it be liquidated, because they have now sat down with these particular parties and they have agreed to come up with a scheme of arrangement. So mergers is simply whereby two or more companies combine their assets. So once this one has actually been taken or basically proposed by the board of directors, it will basically be presented, for example, to the shareholders of the company. So once they approve, the two companies can actually be able to merge their assets. We've given dominant examples, NIC Bank and Commercial Bank of Africa. So they basically merged to form what we call NCBA. So it became one entity. So they simply combined their assets. So there are several things that are actually supposed to happen here. For example, there's what we call post-merger integration, because they have to deal with things like, let's say, for example, culture shocks, which we are going to look at. Culture shocks in terms of the employees. So we need to prepare them, for example, in advance, that we are going to be able to merge and become one entity with another entity. You know, the culture at NIC, you know, the same as with the culture at Commercial Bank of Africa. Maybe the employees here are used to basically working up to 3 p.m. The employees here are used to working up to maybe 6 p.m. So having to combine the two cultures, it simply means that there has to be proper communication to the key stakeholders, for example, the employees, so that this merger might not actually fail. Because if you don't basically prepare the employees very well, it is likely to fail, because they are supposed to play a key role when the merger is actually supposed to happen. So that is basically what we mean by a merger. So simply two entities or two companies combining their assets to become one entity, What could actually happen, one of the entities can actually be absorbed by the other, such that it loses its identity. That's what we call it absorption. Or sometimes they could actually basically decide to merge and actually basically maintain their identity. So if that one actually happens, you can simply say, for example, one of the entities has actually been absorbed by the other. Acquisitions, what we mean by acquisitions, it is, for example, that circumstances or situation whereby you find we have this one meeting. So you know one of them will actually simply disappear. So for mergers, we have this one. So they basically come together to form a union, so under a merger. But under this one, where a cat meets a rat, this rat will actually simply disappear. So that's what we mean by acquisition. So one of the entities actually acquires the other entity, and it is actually able to control its activities or actually affairs. So in this case, for example, we could talk about Kenya, for example, Kenya Commercial Bank having acquired, for example, Jamii Bora Bank. So they simply changed the name. I don't know if it's to Kingdom Bank or something. So they acquired Jamii Bora Bank. So if this one actually meets this one, the rat will actually disappear. So one of the entities actually disappears. And of course, all the activities are actually controlled by the cat. So we normally have what we call the target company. And of course, we have the target company and the predator. So the predator is like now the cat. And of course, the target company is now like the rat. So the predator is the cat. The target company is like the rat. So the rat will actually simply disappear. So once this one actually meets the husband and the wife, they form one entity. Is like now the merger. So it's like a 50-50 coming together. So divestitures, what do you mean by a divestiture? A divestiture is simply whereby the company decides to do away with non-performing product lines. So they do away with that particular product and all assets accompanying that particular product in terms of, for example, the production and maybe technology. So they sell it to another company. For example, the company could be having several product lines, but one of the product lines is not actually performing so well. So what they decide to do is to sell off that particular product because it is loss-making to them. And of course, it is just being sustained by these other product lines. So we could talk about, for example, if we have these particular companies, so we have this company. This company is actually famous for producing alcohol. But of course, they could have one product that is actually a soft drink product. But this product is not actually performing so well. So they could decide to sell off that particular product to another big company known as Coca-Cola. You know what Coca-Cola does? It basically specializes in soft drinks. So they sell off this particular product because it is just being maintained by the alcoholic products, which are actually very profitable. So if the company discovers that, they can simply be able to restructure by simply selling off this particular product line to this other company, because maybe they have the expertise or knowledge of how to tap into the market of soft drinks. So they can sell off this product. If they do that, we say the company has been able to divest. So they simply do away with product lines or non-performing product lines of the company, and they sell them off to other companies so that maybe they just concentrate on the most profitable products of the company, or the ones they're actually able to sell very easily to maybe the customers. Share capital reduction, so I think this one we've already looked at it. We looked at it under share capital. Share capital reduction is simply where the company decides to reduce its capital in the company. So due to maybe several reasons, maybe it has excess capital. There are no assets to represent the share capital, so they can decide to reduce the share capital. And then we have joint ventures. So joint ventures is simply whereby, or a joint venture is simply whereby two entities contribute capital. So they contribute capital and actually invest in one entity. So maybe this one produces 50% of the capital, the other 50%, and they simply put in one entity, or basically invest in one entity. So that is what we call a joint venture. So in a nutshell, or basically in short, that is what we mean by corporate restructuring. That is what we mean by corporate restructuring. And basically that is the importance and of course some of the types of corporate restructuring. So our key focus here will basically to look at what are compromises, what are mergers and how it happens, and what are actually acquisitions and takeovers. For these other ones, you can just actually be able to understand them. So you have others like, let's say, for example, reverse merger. You can have what we call reverse merger. So reverse merger, don't confuse it as the opposite of a merger. What we mean by reverse merger, a reverse merger is whereby shareholders in a private company, so they have their own company, which is actually a private company, decide to go public, or basically decide to convert their interest into a public company by acquiring an already existing shell public company. So there's a public company that has been registered, but it's not actually functional. It is just idle. It is just there. So what they do, because they want to convert their interest from actually being a private company, they simply acquire or buy that particular public company. If they do that, we say they have done what we call a reverse merger. It is normally advantageous because the company will actually avoid what we call an initial public offer. They don't have to come up with a prospectus as a private company to be able to convert it into actually basically becoming a public company. So they simply just, for example, leave the private company and invest all their interests in the shell public company that has already been registered. So it avoids the hassle, the time, the costs involved in doing an initial public offer, having to basically invite people to buy the share so that it can become a public company. If they do such, we say they have done what we call a reverse merger, converting their interests from a private company and actually becoming a public company by simply buying or acquiring an existing shell public company, public company. So maybe we can start by looking at what are compromises and schemes of arrangements. So you can just be able to see. So I kindly repeat divestiture. So let's just see. There's a bit. So divestiture means an outsell of all or substantially all the assets of the company or any of its business undertakings or divisions, usually for cash or for combination of cash and debt, and not against equity shares. In short, divestiture means sale of assets, but not in piecemeal manner. Divestiture is normally used to mobilize resources for core business or business of the company by realizing value of non-core business assets. So what they talk about by non-core business assets is what I'm just talking about, non-performing products which are not performing. You just sell them off, or maybe you will have several divisions of the company. So this one deals with maybe manufacture of maybe stationery. This one deals with maybe manufacture of books. So the one for manufacture of books is actually performing so well than that one of stationaries. You can sell that division of stationery and basically take those assets in terms of money and invest in this one that is actually performing so well. For example, if you are dealing with maybe clothing, so you have a line that is dealing with maybe footwear, the other one is dealing with maybe ladies cloth, the other one is actually dealing with maybe men's suits. So the one for ladies is actually doing so well. So ladies are actually really acquiring cloth or maybe their shoes, but the one for suits for men is not actually performing so well because men are not actually basically doing a lot of shopping each and every time. So once they have maybe 6 suits or 7 suits, they're actually good to go. But for ladies, they might probably maybe do a lot of shopping each and every month once they get their salary. But for men, so just once in a while. So you find that this one for men is not really performing so well. So you decide, let me sell it off and basically just concentrate on ladies' shoes and of course, ladies' clothing. So you do away with that division or sell of that particular product line to another person who maybe knows how to go about it and actually put the resources or basically put the resources in the performing areas of the business. So we have another one which I had not mentioned, demerger. So demerger is now like the opposite of merger. So demerger is a form of corporate restructuring in which an entity's business operations are segregated into one or more components. Demerger can take 3 forms. You can have spin-off, split up, or maybe split off. Then reduction in capital, what I've just gone through. So joint venture is an arrangement in which 2 or more companies called joint venture partners contribute to the equity capital of a new company called a joint venture in pre-decided portions. So maybe they agree this other one is going to contribute 60%, this one 40%, and they contribute the capital and invest in one entity. So buyback of securities is actually also one of the ways of actually restructuring. So when the company is holding excess cash in terms of capital, they can simply be able to buy back the securities or basically buy back the shares of the company. So we have these other ones that I've just mentioned briefly, mergers or amalgamation. A merger is a combination of two or more businesses into one. Amalgamation is the merger of one or more companies with another, or the merger of two or more companies to form a new company in such a way that all the assets and liabilities of the amalgamating companies become assets and liabilities of the amalgamated company. So it's simply whereby two or more companies combine their assets and all their liabilities to become one entity. It can be through what we call absorption. So what do we mean by absorption? So absorption is a combination of two or more companies into an existing company. All companies except one lose their identity in such a merger. So you can see what they are saying. What we mean by absorption is like one of the companies absorbs the others. It absorbs the others. So the other one loses the identity. Like in this case, we could talk about, for example, QuickMart simply absorbing Tumaini. Tumaini loses the identity. And of course, the people just know, like, or assume that particular supermarket was actually QuickMart, yet it was actually absorbed. So they merged with another one and it was actually absorbed and lost its identity. So people no longer know about what we call Tumaini. They just know QuickMart. But of course, they merged and actually formed one entity. So that's what we mean by absorption. They're simply merging by absorption. One of the companies actually loses its identity. So maybe you can give another example in the banking industry. For example, we used to have a bank known as Gyro Bank or Giro Bank. I don't know if some of you know it. So like this Giro Bank. So Giro Bank, I don't know if it was acquired or they merged with I&M Bank. So Gyro Bank actually lost its identity. So you can Google online what actually happened with Gyro Bank and I&M. So I&M Bank basically acquired, I don't know, they acquired or they merged with Gyro Bank. So all the banks that were actually basically known as Gyro Bank were basically rebranded and actually became I&M Bank. So it was actually simply absorbed and lost its identity by I&M Bank, by I&M Bank. So merger through consolidation is a combination of two or more companies into a new company. In this form of merger, all the companies are legally dissolved and a new entity is created. So now in this case, both of them lose their identities. So they lose their identity and actually they basically form a company under a new name. So we can look at basically look at more about what is corporate compromises and schemes of arrangement. So what do you mean by this? The provisions of the Companies Act regarding compromise or schemes of arrangement are mainly applicable to those companies liable to be wound up under the Companies Act. So the provisions can apply to companies which are in the process